Australia needs to build 260,000 homes a year to meet the government's own housing accord target. We're currently building about 175,000, and the gap is getting wider. In the first 15 months of the accord, we fell 81,000 homes behind. I'm telling you this because while everyone's arguing about interest rates, tax changes, this is the number that's actually going to determine where property prices go over the next 5 to 10 years. Australia has a housing supply crisis, and until it gets fixed, prices in the markets where supply is tightest are going to keep climbing. So in this video, I want to walk you through the undersupply data, explain why none of the policy announcements you've been hearing about are going to fix it, and then show you what we're doing about it from an investment perspective. There's been a lot of noise in the property space recently with the government's recent CGT changes, negative gearing reform, budget spending, recession fears, and rate predictions. And these are real conversations that affect real people, but most of them are about demand. They're about who can buy, how much they can borrow, and what the government is doing to make it easier or harder for people to get into the market. But if you're making investment decisions based on those headlines, you're watching the wrong numbers, because the supply side of the equation is the one that actually drives prices over the long term. It doesn't matter how many demand levers the government pulls if there aren't enough homes for people to live in. And right now, there aren't. Australia's population grew about 423,000 in the year to March 2025. And 75% of that growth came from migration. Net overseas migration hit 538,000 in 2022 to 2023, came down to 429,000 in 2023 to 24, and was about 306,000 in 24 to 25. Treasury is forecasting 260,000 for this financial year and 225,000 for next year. But the leading indicators from permanent and long-term arrival data suggest that the slowdown may have stalled. And to put that in context, since the year 2000, Australia's migrant population has more than doubled, while the number of housing units has only increased by 54%. We've been building at roughly the same pace for decades, while the population has accelerated, and the result is a structural gap between how many homes exist and how many people need one. The rental market tells the same story from a demand side. National rental vacancy is sitting at 1% on SQM Research's measure, and it was 1.6% on Cotality's. The pre-2020 decade average was somewhere between 2.5 and 3.3%. Perth is at 0.6 vacancy right now. Adelaide is at 0.7%, Brisbane 0.8%, and Hobart is at 0.5%. So you've got a growing population, a rental market that is extremely tight by historical standards, and a supply pipeline that isn't keeping up. And the data on what we're actually building confirms that the gap is widening rather than closing. The federal government set a target of 1.2 million new homes over the next 5 years under the National Housing Accord, starting from July 2024. That works out to be about 240,000 homes a year, and realistically, you need to be hitting closer to 260,000 a year to account for the slow start. So where are we actually tracking? In the first 15 months, about 219,000 homes were completed against a target of 300,000. That's a shortfall of 81,000 homes, or 27% below where we need to be. Dwelling approvals are telling a similar story. In the first 20 months of the Accord, 322,000 homes were approved against a target of 400,000, and the government has missed the minimum monthly approval threshold of 20,000 every single month since the Accord started. The National Housing Supply and Affordability Council's own forecast says that the 1.2 million target won't be reached until at least June 2030, which is a full year late. And Master Builders Australia is forecasting a final shortfall of around 380,000 homes by 2030. To give that number some scale, 380,000 homes is roughly the entire dwelling stock of a city the size of Adelaide. And even when homes do get approved, they're not getting built at the rate they used to. Construction times have blown out, commencements have stalled, and the construction sector itself is under serious pressure. Build costs in the sector are roughly 35% higher than they were in 2019. New apartment build costs went up 18.2% in 2024-25 alone, and the townhouse build cost went up 18.8%. Construction insolvencies have been running at record levels for 4 straight years now, with nearly 3,600 recorded in 2025, which is about 27% of all company insolvencies in Australia. So the industry that's supposed to be delivering these homes is losing builders faster than it can replace them. And within that, there's a specific type of housing that's disappearing from the pipeline almost entirely. Apartments and townhouses approvals fell 24.5% in a single month in January 26. Developers are abandoning medium density projects at the affordable end because the margins don't work anymore. It costs more to build a new boutique townhouse block today than what the existing ones sell for in a lot of markets. Tim Gurner, who has about $14 billion in pipeline projects, has publicly said the boutique and affordable end is now unprofitable to build at current cost to value ratios. So the supply of these type of properties is shrinking, and the ones that already exist are trading below what it would cost to replace them. So you've got a national target that's already 81,000 homes behind after 15 months, an industry that's losing builders at record rates, build costs that have gone up 35% since 2019, and a medium density pipeline that's actively contracting. The supply side of the equation is broken across multiple levels at the same time. Given how bad the supply numbers are, you'd expect the government to be focused on getting more homes built. And there have been announcements. The 2026 budget included changes to CGT, negative gearing and trusts. There's been an expansion of the 5% deposit scheme. There's money committed to infrastructure for new housing developments. But when you look at what these changes actually do, almost none of them add to a single home to the supply pipeline. The 5% deposit scheme expansion is probably the clearest example. Since 2020, it's helped about 240,000 Australians into home ownership, which sounds like a positive outcome. But removing income caps and place limits means more buyers are now competing for the same pool of existing homes. 1 in 3 first home buyers nationally is now on a government-backed loan, up from 1 in 10 in the scheme's first year. And Cotality's data confirms what you'd expect. Lower quartile prices are rising fastest in cities where the scheme is most active. It's a demand-side stimulus, and it pushes prices up without adding any supply. The negative gearing changes from the budget limit deductions on established housing to residential property income only, while new builds keep the full benefit. The intent is to redirect investor money toward new construction. But these changes make it less attractive to sell existing properties, which removes both sale supply and rental supply from the market. So you're potentially disincentivizing people from selling while also not building enough new stock to make up the difference. Properties purchased prior to budget night are proposed to be grandfathered under the existing negative gearing rules, meaning investors would retain full benefits until the property is sold, further reducing the incentive to sell established stock. And on the construction side, the budget committed $2 billion in power, roads and drains for new developments, which is projected to support about 65,000 new homes. There's also $45 million for a single-touch approval process to combine federal and state planning approvals. Both of those are steps in the right direction, but they're modest relative to the scale of the shortfall. HIA research shows that government taxes, charges, levies and regulatory costs now make up close to half the cost of a new home in Sydney, 43% in Melbourne and 41% in Brisbane. That share has roughly doubled in the last 5 years. In Melbourne alone, the government component has risen by $150,000 per home. And the average subdivision approval now takes more than 12 months, with about 7 months of that classified as unnecessary delay. So even when someone wants to build, the cost and the timeline make it harder every year. If you removed stamp duty on new builds, you'd save about $55,000 per home. If you removed GST on a new home construction, another $50,000. If you halve the developer and council infrastructure charges, about $45,000. And if you cut the unnecessary approval delays, you take roughly 4% off the final price. Those are HIA's numbers, and any of those two combined would make a material difference. But none of them are on the table right now. The government is spending money and making announcements, but most of it is working on the demand side, while the supply side continues to fall further behind. So what I'm trying to say is that the supply gap is real, it's getting worse, and the current policy settings aren't closing it. The question for investors is what that actually means for prices and for the types of properties you should be looking at. Cotality's most recent data makes the connection between supply and price growth very clear. The cities with the lowest vacancy rates and the tightest supply are the ones with the strongest growth. Perth is at 0.6% vacancy and 24.3% annual growth. Brisbane is at 0.8% vacancy and 19% annual growth. Adelaide is at 0.7% vacancy and 11.4% growth. And across the board, lower quartile properties are outperforming the upper quartile because that's where borrowing capacity constraints are concentrating by demand and where supply is most constrained. In Sydney in Q1 2026, the upper quartile fell 1.8%, while the lower quartile rose 1.8%. That's a 3.6% point divergence in a single quarter in the same city. Melbourne shows the same pattern. Upper quartile fell 1.6% over the quarter, while the lower quartile still managed 0.7% growth. And this is in a market where the headlines are saying the whole city is declining. From an investment perspective, the data points to 3 things we're acting on right now. The first is the outer ring growth corridors and capital cities where supply is constrained, and population growth is still strong. Suburbs in Melbourne's Melton region, Frankston, and Brimbank are all showing strong growth because they combine affordability and genuine owner-occupier demand, while building approvals are low in specific suburbs we're buying in. The second is the boutique unit and townhouse segment. Medium density approvals are falling, developers are walking away from affordable projects because the margins don't work, and the existing stock is selling below replacement cost in a lot of these markets. A 2 or 3 bedroom townhouse in a block of 4 in a strong metro suburb is a different asset to a 2 bedroom apartment in a block of 300. But the data doesn't separate them. When you look at the individual properties, the boutique end has constrained supply, strong owner-occupier appeal, and a price point that's only going to widen against what it costs to build new. And the third is Melbourne more broadly, because it's the most affordable major capital city relative to its size and population base. The median price gap between Sydney and Melbourne is now over $600,000, which is well over the long run average. Melbourne's apartment delivery is forecast to average about $9,000 a year through to 2030, which is roughly 25% below Sydney's. So you've got a city with a growing population, a construction shortfall, a deep price discount to the comparable market, and suburb level data showing double-digit growth in the areas we're active in. The undersupply story is the one that fits underneath everything else in the property market right now. Interest rates will move around, government policy will keep changing, sentiment will swing between fear and greed, but the structural gap between how many homes Australia needs and how many it's building is widening. And until that changes, prices in markets where supply is tightest are going to keep moving up. The opportunity for investors is being specific about which markets and which asset types have the strongest supply-demand fundamentals, because the growth isn't spread evenly and buying in the wrong part of the market won't give you the same result. If you want us to map out what this looks like for your situation, there's a link in the description to book a clarity call.